Hello everyone and welcome to today's Mint Money session in which we're going to be talking about the CPSE ETF. The CPSE ETF opens to the public on 31st of January. This is a kind of mutual fund which trades actively on the stock exchange. So you can buy and sell units of the ETF on a stock exchange. You do need a demat account and a trading account in order to do this, and you place the order through your broker. The CPSE ETF in particular has a portfolio of 12 public sector companies. This was recently rejigged from the 10 PSUs that it earlier had. Investors in this offer of the CPSE ETF, which is called the Further Fund Offer 6, FFO 6, are being given a discount of 3%. The discount is on the weighted average price of the companies in the ETF on the 31st of January. Investors in previous FFOs have also been given discounts ranging from 5 to 3%, so the current one is at the lower end of that band. So what are the pros of this ETF? According to Nippon AMC, which manages the ETF, there are 4 reasons to invest in this fund principally. First, these are public sector companies which are quite well established in their sectors and have near monopoly status. They are trading at relatively attractive valuations, which means they are cheap. You get a 3% discount on these PSUs, and investing in the ETF will give you exposure to a basket of PSUs rather than you having to buy individual companies. So how has the CPSE ETF done in the past in terms of returns? The ETF was launched in March 2014 and has proved to be a bit of a disaster. In the past 3 years, it has given returns CAGR of around negative 6.5%, and in the past 5 years, it has given returns CAGR of negative 2.5%. This compares to around 15% in the Sensex over the past 3 years and 8% over the past 5 years. So what do the experts have to say? First of all, they are concerned about the government ownership of these companies. According to Dipali Sen, founder Srujan Financial Advisors LLP, government ownership of such companies leaves limited room for independent thinking and professional management. Second, the experts are concerned about just how concentrated the ETF is. While there has been a rejig in the CPSE index, the concentration is in 12 stocks, with 4 to 5 of them making about 75% of the index. The ETF is also heavily exposed to the energy industry, which is highly cyclical. Even seasoned investors tend to stay away from such concentration, says Nitin Sasikumar of Investography. Third, the experts say that grabbing and running with the discount is a highly risky strategy. The 3% discount is not large enough arbitrage and will be partially eaten up by transaction costs like brokerage and tax. Investors should avoid any kind of short-term discount trade. That is more for qualified institutional investors, said Prateek Pant, Head Products and Solutions, Sanctum Wealth Management. Fourth, they say that investors can get the benefit of passive investing through a diversified ETF. Those who want passive funds should go for diversified ETFs such as those pegged to Nifty, Nifty Next 50 or even Nifty Midcap 100, said Pant. So should you subscribe? If you look at the design of the ETF and what experts have said, this does not sound like a great proposition. That's all from us on Why Not Mint Money. Thanks for tuning in.